Good day class, mag-aaral tayo ulit and supposed to be ay nasa lesson 1 na tayo ngayon sa midterm period pero meron tayong isang lesson na napag-iwanan sa prelim period. So, dahil sa mga holidays, sa mga special events ay nakulangan tayo ng panahon kaya hindi natin napag-aralan yung lesson 5 from the prelim period. Kaya dyan ako magsisimula. Siguro magiging introduction na ito para sa ating midterm period. Ang references na gagamitin ko ngayon sa ating pag-aaral ay yung sinulat ni Liana Kelly na ang title ay What is Investment Risk? Sinulat niya yan sa website ng investmentu.com. Ang daming mga excellent writers sa website niya yon. Updated ang kanyang article na ito noong 2021. At ang isa pang reference ay yung sinulat naman ni Samuel Becker na ang title ay 6 Investment Risk Management Strategies. Sinulat niya yan noong 2023 sa website ng sophie.com or Social Finance. So ang website na yun is about financial literacy. So kaya ito yung mga napili ko ng mga references sa pag-aaral natin na ito dahil sa napakaganda ng kanilang mga sinulat. Base sa sulat ni Liana Kelly, from an early age, we all grasp the idea of risk. However, our perception of risk usually revolves around immediate consequences. We tend to focus on immediate outcomes. But investment risk operates on a different timeline. The consequences may not manifest or materialize for years. It involves numerous factors. It's not just one element. Financial risk is a broad term encompassing different risks linked to investing money, emphasizing the chance of losing money on investments rather than holding it in safer cash accounts. For instance, putting 5,000 pesos into stocks could lead to a substantial loss during a severe economic decline, dropping the value to only 500 pesos. On the flip side, in a thriving market, the same investment could skyrocket to 50,000 pesos in just a year. Diversifying your investments involves accepting risk in the hopes of seeing your money increase. Different investment options aim to find a middle ground between risk and potential gain. Choosing high risk options often means the possibility of greater returns, while prioritizing low risk investments results in lower potential rewards. In essence, risk is about the willingness to potentially lose something in order to gain something of equal value. For example, if you put 5,000 pesos into an investment with the expectation of earning 1,000 pesos, then you need to be ready for the opportunity of losing that same 1,000 pesos. Smart investors see this concept as a way to assess their resilience and capability. They view this principle as a means to evaluate their ability to endure and perform. The concept of investment risk is not tied to just one factor, but includes a range of risk factors that collectively impact the overall risk involved in investing. So, isa-isahin natin yon. And sa mga susunod nating pag-aaral, i-isolate ko ang bawat isa dito and then tatalakayin natin ng mas malalim. Siyempre, unang-una, yung business risk. The success of a business is heavily dependent on the decisions and leadership of the executive team. Investing in a company involves trusting their vision and, of course, management style, which carries a level of risk. It is important to consider the legal risks associated with the actions of representatives of the company. Ang susunod ay yung volatility risk. The risk of volatility is caused by the fluctuations in market prices, driven by both positive and negative forces based on market sentiment. This daily market volatility, filled with unpredictable ups and downs, is an inherent risk that investors have to accept due to various external factors, influencing the market. This daily uncertainty of market fluctuations creates a risk that investors must acknowledge and be willing to navigate. Ang pangatlo naman ay yung inflation risk. Investors face a potential risk of diminishing investment returns due to inflation, especially in specific industries. Sudden spikes in inflation can lead to poor investment performance or unfavorable investment outcomes and may result in financial setbacks. Susunod naman ay ang susunod ay interest rate risk. Interest rate risk refers to the possibility of a decrease in the worth of an asset due to unforeseen changes in interest rates. This risk is typically linked to fixed income assets like bonds. Sa mga susunod na lectures, tatalakayin natin yung bonds, kung ano yan. Kakalabitin natin ng konti ngayon. Fixed income assets like bonds rather than equity investments. The price of a bond is significantly influenced by the prevailing interest rate, meaning that when interest rates go up, bond prices tend to fall. Bonds and loans have distinct purposes. Bonds are an investment that generates interest, while loans are a type of credit that must be repaid with interest. A bond is not the same as a term loan because a bond issuance involves negotiation between a financial institution and an investor, while a loan is a negotiation between the financial institution and the borrower. Ang susunod naman ay ang liquidity risk. Having too much of your money invested in assets that cannot easily be converted to cash can be risky in terms of liquidity. If the need arises for immediate access to your funds, you may face the dilemma of either experiencing a temporary financial difficulty or being forced to sell your investments sooner than anticipated. The combination of various factors often determines the level of risk associated with an investment. In addition to those that can be considered, there are unpredictable and unexpected risk factors can also arise due to random events. Market performance is influenced by countless variables, making it unfeasible to consider all of them. Therefore, it is more practical and it is more effective to prioritize analyzing the major risk factors before making any investment decisions. Determining your risk tolerance is essential when it comes to investing. Rather than trying to avoid risk altogether, it's important to consider how much risk you are comfortable with in exchange for potential rewards. Your risk tolerance is the level of risk you are willing to take on in pursuit of returns. It's crucial to assess how much money you are willing to potentially lose in order to gain a certain amount. This is a necessary step for anyone considering investing their money. Understanding that risk tolerance can evolve and that risk levels differ from one situation to another is again crucial. A 60 years old investor should have a lower risk tolerance than a 20-year-old due to their investing time frame. Similarly, a person earning, let's say, 360,000 pesos annually would likely have a higher risk tolerance for a 50,000 pesos investment compared to someone earning 160,000 pesos a year. So it's important to assess your risk tolerance for each investment and proceed with confidence when investing. When you decide to invest, you are also deciding to take on risk. It is important to consider the potential reward when analyzing investment risk. Investors should determine their comfort level for potential losses and ensure that the potential reward is equal or even greater than the risk. Risk capacity refers to the amount of potential loss an investor can tolerate without jeopardizing their financial security. This can differ depending on factors such as age, individual financial objectives, and the time frame set for achieving those goals. Isa pang dapat i-consider pag pinag-usapan natin yung risk tolerance ay yung need, which refers to what level of return must these investments generate in order to help the investor reach their desired financial goals. An investor who heavily relies on investments may need to carefully manage the balance between risk and caution to achieve their objectives. Isa pa na dapat i-consider pag pinag-uusapan ng risk tolerance ay ang emotion. It can be difficult to anticipate how an investor will respond to negative news, whether they will react with fear and panic or with clarity and control, and how these emotions will impact their investment choices. Ultimately, it's crucial to keep in mind that markets generally trend upwards over time, while short-term market fluctuations are a possibility. It is a risk that comes with investing. Make sure to approach investing with a long-term perspective and view investment risk as a way to gauge your comfort with volatility. Your tolerance for risk may evolve over time, so it's important to regularly evaluate and ensure that you're not taking on more risk than you are comfortable with in your investments. So ayon kay Samuel Becker, mayroong 6 siyang itinuro tungkol sa investment risk management. Number 1, reevaluating portfolio. At syempre kasama dito ang portfolio diversification. The practice of spreading investments across various asset classes and sectors is a wise strategy to minimize risk during market downturns. Rather than putting all your money in one place, it is advisable to invest in multiple mutual funds that cover different styles and types of stocks, as well as allocating a portion to bonds based on your investment timeline. Care should be taken to avoid overlap among funds, as investing in similar stocks or sectors can increase vulnerability to losses. Investors can prevent overlap by reviewing a fund's prospectus online before making investment decisions. The second one is lowering portfolio volatility. Maintaining a portion of a portfolio in cash or cash equivalents is a simple way to reduce volatility and avoid the need to sell assets at a loss during difficult times. The suitable amount of cash to hold can vary based on an investor's objectives and timeline, as excessive cash may not provide sufficient returns to outpace inflation. Aside from holding cash, there are other strategies to consider, like portfolio rebalancing. The purpose of rebalancing a portfolio is to mitigate the risk of significant losses by ensuring diversification. As different assets perform variably over time, rebalancing assists in realigning the portfolio to the desired mix based on individual risk tolerance. Despite seeming counterintuitive, rebalancing involves selling off appreciated investments and acquiring those experiencing value declines. So na-topic na natin yon about stock market. Next is investing consistently. Choosing the correct stock and selling it at the right time is again crucial for those seeking quick returns. But it requires patience, discipline, and a focus on the long term, allowing investors to keep their emotions in check. With this strategy, investors consistently contribute the same amount to their investment account at regular intervals, buying more shares when the market is down and fewer shares when it is up. While this method may not provide immediate gains, over time, it can potentially yield a significant return compared to traditional savings as markets generally trend upwards. The next step to strategically manage investment risk is getting an investment risk analysis. For a long time, financial experts have categorized investors' risk tolerance as aggressive, moderate, or conservative. But these assessments are often subjective and can vary depending on the individual's perspective. For example, what is considered moderate for a young investor may be different for an older professional. An individual's reaction to market fluctuations or changes in their financial situation can also impact their perceived risk tolerance. To address this ambiguity, many experts in the financial field are now utilizing software programs to assess an investor's risk attitude through a series of questions. These tools can provide a more objective evaluation of an investor's risk tolerance and help determine how well their current portfolio aligns with a specific risk score. Number 5 is requiring a margin of safety. The well-known saying, buy low, sell high, is often heard in the financial world, but putting this idea into action can be challenging. Who determines what is considered low and high? Value investors may apply their own safety net by only buying a stock if its current market price is significantly lower. So dapat wag mong kalilimutan yun na mayroong margin of safety. Kung hanggang dito lang talaga, wag ka nang lalampas doon. Hanggang doon lang talaga. So may boundary, may limit, at kung narating na yon, then kahit natitempt ka pa na mag-invest pa, pero kung nandun ka na sa margin of safety, then you need to stop. Last one is the establishing a maximum loss plan. Implementing a maximum loss plan is a strategy for investors to carefully oversee their asset allocation. By establishing a maximum drawdown limit personalized to their risk tolerance, investors can steer clear of making impulsive decisions driven by market fluctuations. This plan offers a degree of control over portfolio risk by calculating a personal maximum loss threshold, leading to a tailored asset allocation strategy. However, it is important to note that what works for one investor may not necessarily be suitable for another, as it is not a one-size-fits-all approach.